So this is the fourth one. What was the third recognition? What are you recognizing and measuring? I want to hear it from the group. Yes? Yes, you're actually recognizing and measuring assets. So then the next one is recognition and measurement of goodwill. Goodwill is defined as a future economic benefit arising from the other asset purchase in business combination that are not identified and recognized separately. So when you talk about goodwill, it's actually the reputation of the business. So anytime you talk about goodwill, it is the reputation of the business. Now, how do you get the goodwill in terms of revaluation? In essence, goodwill is an extra amount paid by the acquirer above the fair value of the net asset acquired. So any value that the acquirer is paying above the net asset is what we call goodwill. So you will do the combination, you do the comparison, you actually realize that the net value is less, but the acquirer, the fair value is high. So in such case, we say there is goodwill. For instance, an acquirer might pay extra because of expected synergies or anticipated future growth of the combined business. Now, why is somebody paying excess or extra amount of money? The reason is very simple. It is because one, maybe you're paying it in extra because of the reputation of the business, or number two, you're paying extra because the future of this company is promising. So that is why when you're paying goodwill, it is a recognition to the seller that he has done this much, and now you're actually appreciating, you are honoring his effort. And then number two, you are paying the goodwill because you are focusing in the future. How will the behaviors of the business will be in the coming future? As general rule, the amount of goodwill is determined using the fair value of the consideration transfer. The basic formula used in the calculation of goodwill is as follows. Now, this is the formula. Goodwill equals to fair value of the consideration transfer plus non-controlling interest minus fair value of net asset acquired. So we have fair value of the consideration transfer, how much you're paying, plus non-controlling assets minus face value of the net asset acquired. Now I want to do some examples. There is a question here. I'm just giving this as an example for us to have that perception on how do you come up with the goodwill. Now here we have what? Company A. We have book value, we have fair value. Now our concentration will be in the fair value. Now the fair value from the book value in the example above, because now why are we looking at the fair value more than the book value? Fair value account receivable is lower than the book value due to the uncollection account. Now that is the reason why when you look at the account receivable, you look at the book value, it is 75, fair value is 67. Why? It's because of uncollectible account. Fair value inventory is lower than the book value due to the what? Obsolescence or obsolete. We are talking about inventory 35, 32. So obsolescence means depreciation. Then fair value of the PPI, that is property and building, or other books talk about building and property. Building, property, and equipment is higher than the book value due to the depreciation being greater than the decline in the PPI fair value. Now, this is an example. If a company B purchased a company A for 250,000, the amount of economic goodwill created will be, so what is the goodwill? How do you get the goodwill? Yes, somebody else? So let me get you to